In cities like Sydney and Melbourne, the property market has always been expensive. But now, a new shift is quietly taking place. Across several suburbs in Victoria and Queensland, living is no longer just an option for renters. It's emerging as a serious opportunity for commercial real estate investors. If you look at what experts are saying, the reason is simple. Demand has changed. In cities across Australia, especially in Victoria and Queensland, people are struggling with affordability, flexibility, and availability. At the same time, investors are struggling with low yields from traditional residential properties. Co-living sits right in the middle of these two problems. And its most basic level, co-living is easy to understand. One property, multiple independent tenants. Everyone has their own private room. Sometimes even their own bathroom, and shared spaces are designed to be comfortable and usable. From a living point of view, it offers affordability and community. From an investment point of view, now let's talk about numbers, because this is where commercial real estate starts paying attention. In many parts of Australia, a standard residential property might deliver a gross rental yield of around 3 to 5%. That's considered normal. In some premium areas, yields can even drop below 3%. The property may grow in value, but the cash flow is tight. Now compare that with co-living. Because rent is charged per room instead of per property, the total weekly income can be much higher. For example, a house valued at around $800K might rent traditionally for about $500 to $600 per week. That's roughly a 3 to 4% yield. The same house converted into co-living setup with 4 or 5 rooms could generate $1,200 to $1,500 per week. That pushes yields closer to 7, 8 or even 9% in some cases. This is exactly why commercial investors are stepping in. Commercial real estate has always focused on yield, cash flow, and risk management. Co-living ticks all three boxes. The income is higher, the demand is consistent, and the risk is spread across multiple tenants instead of relying on just one. In Victoria, co-living has gained traction in inner and middle ring suburbs where rental demand is strong. Some co-living projects and high-density shared housing models are already reporting yields in the range of 7 to 8%. In Queensland, particularly in Brisbane and key regional areas, yields can be even stronger. Some suburbs are showing returns close to 10% or more, especially where housing demand is driven by migration and job growth. Another important factor is vacancy risk. In a traditional renter, if the tenant leaves, the income drops to zero until the property is leased again. With co-living, if one tenant moves out, the property still earns income from the other rooms. That stability is something commercial investors value deeply. It smooths cash flow and reduces stress. This is also why co-living is starting to appear in conversations alongside offices, retail spaces, and mixed-use developments. Developers who once focused only on office towers or shopping centers are now looking at residential models that behave more like commercial assets. Co-living fits naturally into that thinking because it operates on systems, occupancy rates, and income streams, not just emotional buying decisions. From the tenant side, the story matters too. Many renters today don't want to lock themselves into long leases or live far away from the work just to save money. Co-living offers flexibility and affordability and a sense of connection. That demand is not temporary, it's being driven by lifestyle changes, rising costs, and population growth. And this is why experts are calling co-living a growth area rather than a trend. Trends come and go. Growth areas respond to real problems. Co-living addresses housing affordability while also improving investment performance. That balance is rare in property. Of course, this doesn't mean every investor should jump in blindly. Co-living requires the right location, the right design, and proper management. But the reason commercial real estate is paying attention is because the fundamentals make sense. Strong yields, resilient income, and long-term demand. When you see co-living being discussed in commercial real estate reports, it's not because it sounds interesting. It's because the numbers support it and the demand is real. Commercial property always follows cash flow and sustainability, and co-living is starting to prove it can deliver both. So when people ask why co-living is suddenly being taken seriously, the answer is simple. It works for people living there, and it works for investors behind it. And that combination is exactly what commercial real estate looks for when identifying its next opportunity. If this perspective on co-living and commercial real estate is useful to you, take a moment to like the video and subscribe to the channel. So this is Rajan Sharma, COO of Investor Partner Group, signing off. If you have any questions, feel free to DM me or post your queries in the comments, and stay tuned for more such interesting videos that are always upcoming in our channel.